Major averages up more than 1%. Investors looking to the Fed. We're back above 26K for the first time since May 6th. Our Bob Pisani and Mike Santoli here at Post 9 to talk about what is going on today. What explains all of this?
Obviously, the context is all week I've been saying everyone got very negative. You saw flows out of equity funds, so therefore people weren't prepared for less bad news. And we got a lot of less bad news. Obviously, the jobs number at the outset today was on the weak side, does not say great things about the economy. But because the market was already rooting for a rate cut before too long, I think we got confirmation there. Now, we get these headlines about trade. If that's going to thaw out a little bit, I don't know if that plays into the Fed story. Right now, on a day like today, I think people are just going to say, we don't own enough. We got too defensive, and we're going to buy stocks today. I just would remind folks, though, last jobs report, May 3rd, S&P up 1% on 263,000 new jobs. People said the economy is great, it's resilient. The story changes, right? It doesn't always progress from Jobs Friday out to the next week, because that was the high for 4 weeks.
Yeah, so we're back to bad news is good news, unfortunately, which is my worst kind of scenario. I hate that when that happens. But we got job growth slowing, but now we've got the Fed to the rescue, right? They're going to come and rescue us. We've got a deal that they think is going to be made in Mexico, they think. Well, we have Mnuchin meeting with his PBOC counterpart over the weekend. They're going to exchange friendship rings and set up a meeting with the president. All this is hopium right now. That's what we're going on right now. Other than job growth is slowing, that's the only actual fact that we have to work on today. The rest is just an idea that things are going to happen. What I'm worried about is if we don't get a clear deal on Mexico very quickly, the third quarter is going to kick in for earnings, and they're going to take the numbers down big time. Remember what's happened the last 6 weeks? Nothing. Remember December, January, February, March? They were crushing the earnings estimates all the way down for second, third, and fourth quarter, and it stopped in the middle of April. There's been no change. We got 1% up for the second quarter, 1% up for the third quarter, 8% on the fourth quarter. Those numbers are going to go negative if we have this tariff thing go on much longer, and that's what I think is going to happen in the middle of June if we're still here.
So, Mike, if the Fed doesn't come to the rescue, and based on my amateur reading of the Fed's body language around this, it seems a lot more up in the air than the market is taking it. Then where are we, just based on these job numbers and the other numbers that we've seen out of earnings and whatnot?
So I would imagine what the Fed hopes is that the signals that they've put out there this week that, look, we're listening to the markets, we're aware of the risks, we're going to try to get ahead of those risks, will perhaps be enough, because the markets themselves are kind of easing for the Fed a little bit here, right? Yields are where they are. Maybe they can buy time till July when it's not necessarily expected that they're going to cut until then. So all that can hold together for a while. I think the other thing, though, that the markets benefit from is the S&P hasn't moved on a net basis since January of 2018, right? We're still kind of churning around this same area and sorting it all through.
Is hopium, to use your word, Bob, the reason that the best performing sectors for the week are materials and technology, led higher by semis?
Yeah, and look at the automotive sector. You know, they got crushed on these concerns about Mexico. All of a sudden, Whirlpool's up 12% this week.
Got a big upgrade
up 10%.
this week, yeah.
American Axle's up 10%. General Motors up 6 or 7% today. Yeah, that's all based on the idea that this is all going to sort of go away. By the way, I'm not sure how bad 75,000. I want to remind everybody, the 90% confidence level on the jobs report is 110,000 jobs. That means 90% of the time, the BLS says we're pretty sure it's going to be more that 110,000 up or 110,000 down from the number that we report. So they reported 75,000. We don't even know with a 90% confidence whether there was any job growth at all, because you take 75 from 110, you can get down minus 35,000 at that point. So you can drive a truck through these estimates. There are surveys, and there's a confidence level, and you want to make it better, spend more money to get more surveyors out there, and we can reduce the uncertainty around trying to figure out how good these numbers are.
Government workers were down, so I'm not sure
we could reduce the revisions that we have that make us all crazy trying to figure out what's going on. Spend some more money to get better statistics.
Materials, we mentioned, best week in 10 years. If there's a tariff threat and then you remove the threat, is it likely the market goes back to where it was, goes higher than where it was before, not as far as it was before? I mean,
I think you'll have the movement within the market so that those areas that were bombed out, like materials and like the deep cyclicals and maybe like the transports, if you remove that, yeah, they're going to regain more than the stuff that's kind of held together well. The defensives. What's interesting now is yields are not going up. So there's still an incentive to kind of sit there in the defensive quality yield names. At the same time, the cyclicals are saying, hey, maybe we have some hope. So who knows? I mean, it seems as if it's more about rotation than it is about net movement.
You see the dollar dropping this week, the yields down.
I was just going to bring that up.
Right. You
Thank
see emerging markets lifting on all of that. That's a classic counterplay. Buy emerging markets with yields down and the dollar down overall. Do you think that's a sound strategy? If the global economy is truly... No, I don't. It's a knee-jerk kind of traditional trading reaction. Doesn't seem like the right thing to do.
There is a story, though, coming together. And I keep pointing to 2016. Yields stayed really low. We had all these shocks. Markets held up okay. And you had a G20 meeting where basically they decided the Shanghai Accord, where they basically said, okay, look, we're going to, in concert, try to ease conditions and do some stimulus. I'm not saying it's going to happen at the end of this month exactly that way, but it seems like the consensus is moving in the direction of we have to do something to get ahead of a globe sliding into a worse economic situation.